Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ENOVA International Inc. quarterly report. ENOVA International Inc. offers a wide range of online financial services to consumers and small businesses across the United States, Brazil, and internationally. The company's product portfolio includes consumer and small business installment loans, which provide borrowers with a lump sum payment plan over a fixed period. In addition to installment loans, ENOVA also provides line of credit accounts, allowing customers to access funds as needed while only paying interest on borrowed amounts. The company's CSO, Consumer Financial Services programs, offer loan arrangements with independent third-party lenders and assistance in preparing loan applications and documents. ENOVA's bank programs provide marketing services and loan servicing for near-prime unsecured consumer installment loans. Furthermore, the company offers money transfer services to facilitate secure and convenient transactions. ENOVA markets its financing products under various brands, including CashNet USA, NetCredit, OnDeck, Headway Capital, Simplic, and Pangea. Overall, ENOVA International Inc.'s diverse range of financial services caters to the needs of consumers and small businesses seeking flexible and accessible credit options. ENOVA International Inc. market capitalization of $4 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that ENOVA International Inc. holds a significant advantage in their industry. ENOVA International Inc. trades at a higher price-to-earnings ratio of 14 times and a higher price-to-book ratio of 2.96 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 79% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has aggressively reduced its share count by more than 5%, while revenue, profits, and assets have grown. This represents a very favorable capital allocation strategy, with management materially increasing per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for a financial institution can be attributed to several key factors. Firstly, an increase in loans and finance receivables has been a significant contributor to revenue growth, with a 28.7% year-over-year increase. This is further broken down into interest income from installment loans and loan interest revenue, which saw a notable rise of $114,726, 23.6%, from 2025 to 2026. In addition to the growth in loans and finance receivables, other factors have also played a crucial role in driving revenue growth. The expansion into new markets, such as Brazil, has been a significant contributor, as well as the merger with Grasshopper Bancorp, Inc. Furthermore, the growth in money transfer business, an increase in origination fees, and program fees from bank program have all contributed to the overall revenue growth. It is also worth noting that certain trends have led to an increase in revenue. For instance, originations outpacing repayments has resulted in an increase in the ending balance of small business loans and finance receivables. Overall, these factors have collectively driven revenue growth for the financial institution. The net income of the company experienced a significant increase between 2025 and 2026, rising by $18,154,000 or 25%. This substantial growth can be attributed to various factors that contributed to improved profit margins. One key factor was the increase in net cash provided by operating activities, which boosted the company's financial performance. Additionally, a decrease in depreciation and amortization expenses further enhanced profitability. The change in fair value of loans and finance receivables also had a positive impact on profit margins. As a result of these factors, the company's profit margins improved from 9.8% in 2025 to 10.4% in 2026. This increase in profit margins is a testament to the company's ability to manage its expenses and optimize its financial performance, ultimately leading to higher net income. The company's financial performance is a testament to its ability to generate significant operating cash flow. As evident from various pages of the report, the company has consistently demonstrated a positive operating cash flow in 2026. The figures provided on page 1 and page 18 confirm this, with operating cash flows of $2,341,419 and $1,725,000 respectively. Furthermore, other sections of the report also support this conclusion. On page 10, it is stated that net cash provided by operating activities was $474,540 in 2026, indicating a positive operating cash flow. Similarly, on page 29, it is mentioned that the company's operating cash flow was $207,106, which is a positive figure. The report also explicitly states that the company is generating positive operating cash flow on pages 32 and 36. Additionally, page 39 highlights the company's ability to generate significant cash flow through normal operating activities for funding both long-term and short-term needs. Finally, page 41 confirms this by stating that total cash flows provided by operating activities were $474,540,000 in 2026. In conclusion, based on the evidence presented in the report, it is clear that the company is indeed generating positive operating cash flow in 2026. This is a significant indicator of the company's financial health and its ability to meet its long-term and short-term needs. The company's debt level has undergone significant changes over the past year. Long-term debt has increased from $3,757,351 in 2025 to $4,832,542 in 2026, indicating a substantial rise. However, when comparing the total long-term debt as of March 31, 2026 and December 31, 2025, it is evident that there was a slight decrease from $3,334,297 to $3,015,120. Despite this fluctuation, the overall debt level has increased significantly, with a jump from $3,783,989,000 in 2025 to $4,854,421,000 in 2026. Conversely, as of December 31, 2025, the debt level was lower at $4,522,963,000. In terms of interest expenses, there has been a notable increase from $80,544,000 in 2025 to $94,046,000 in 2026, representing a 16.7% rise. The weighted average interest rate on long-term debt also decreased from 8.91% to 8.18%, which may have contributed to the increased interest expenses. Management is optimistic about the company's outlook, citing its advanced technology systems, proprietary analytical models, and customer acquisition programs as key drivers of success. They attribute their customers' loyalty to satisfaction with products and services. The company plans to continue investing in and expanding its financial services program in Brazil and expects benefits from the merger with Grasshopper Bancorp, Inc. However, management also acknowledges uncertainty in the marketplace due to mixed views on the economy's near-term prospects. They are adjusting assumptions and discount rates used in their models on a quarterly basis. The pending acquisition of Grasshopper will incur costs in the first quarter of 2026, but management is confident that the company has sufficient liquidity to run operations for the foreseeable future. Management notes that cash flows from operations will be sufficient to fund future operating liquidity needs, and working capital growth will be funded through available cash balances, borrowings under securitization facilities, and credit agreement. They are actively managing risk and related credit quality in loan and finance receivable portfolios, and are evaluating the impact of regulatory changes on their business. The company's financial activities have been notable in recent times. One significant development is its decision to buy back shares. This move indicates that the company is confident in its future prospects and is choosing to allocate a portion of its resources towards enhancing shareholder value through share repurchases rather than distributing dividends. By doing so, the company aims to boost its stock price and create a more favorable environment for investors. That concludes the financial summary for ENOVA International Inc. Feel free to comment below, and I will be happy to answer them when possible.